All right. Good evening, everybody. Jon Harris here, managing partner with Fortune Management, and this is 21st Century Dentistry. And I had the pleasure of meeting with Brandon Finazzo and Michael Jerkins with Panacea Financial, Panacea Bank. And we're going to talk about all things financial this evening. So grateful to have both you gentlemen on. I appreciate you taking some time out of your busy schedules and just chatting with me this evening.
Our pleasure. Absolutely.
Thanks. Happy to be here.
And I tell you again, I apologize. I created some havoc trying to get us started tonight. I just moved into a new house. And so the folks that watch this are probably going to notice my background's a little different than it has been in the past. But just moved into a new house. So my studio and my office in my old house were separate. And now they're both in the same room. So I'm kind of trying to figure that one out. But bottom line was when I got everything plugged up, ready to go, nothing worked. So I spent the last hour trying to get my HD camera working, and it wasn't going to work. So I gave up on it. And then when we first jumped on, it seemed as though my audio wasn't working either. And so now I've given up on it. So we're going straight up old school Zoom audio and MacBook Pro speakers. So how are you guys doing this evening?
Wonderful. Doing great.
Fantastic. Lovely.
What's your Thanksgiving's looking like?
I'll be staying here local as in New Braunfels, San Antonio.
Yeah,
so
for me,
Texas, right? Yeah.
Well, Texas sounds almost, for me, I'll be in Arkansas. That's where our main office is. We got folks all over the country that are, I think staying local. But for me, I will be in the great state of Arkansas, Little Rock area for Thanksgiving.
I got you. Very good. What do you think about Oklahoma and Texas coming into the SEC?
Well, I still am anticipating what side of the conference they're going to be on. I've heard multiple theories. So just full disclosure, I follow a lot of SEC football. I'm a Memphis Tiger football fan. So I will say we're 1-0 against the SEC this year against Mississippi State, but in case people are counting at home. But I think that SEC West just got a lot harder. And I feel bad for, the Auburns, Ole Miss, Mississippi State, Arkansas of the world. Basically anyone who's not Alabama, I feel bad for.
I don't know, man. I think Josh Heupel's got the trick figured out in Tennessee. Their program, we've been saying this for years, like it's been a rebuilding year for us for almost a decade.
You're a UT fan. Tennessee, aren't you?
Yeah, we've been keeping that to ourselves here about the last 15 years, but now it's kind of like we're starting to see things move in the right direction. So it's like, okay, so, we put more points on the board against Georgia and Alabama than any other team they played. So I was like, okay, so we're, at least our offense is moving in the right direction. Mm-hmm. But, man, it's been a struggle being a Tennessee fan and being as close to the Alabama line as I am. When you go into a sporting goods store here like Walmart, there's just as much, if not more, Alabama paraphernalia on the shelves as there is Tennessee. But if you go across the state line into Alabama, you will never find any piece of Tennessee anything on a shelf. Just right across the state line.
Yeah, and so I'm a UT alum, actually. Went to medical school at University of Tennessee. Uh-huh. And so I rooted against UT my whole life. No offense to you. I love my alma mater, but sports wise, I got to stick with Memphis. And then I grew up rooting against Cincinnati, and then I ended up working for the University of Cincinnati for many years after that. So I don't know who's next on my sports rivals that I'll end up being affiliated with, but we'll see.
Yeah, we got Butch Jones came from Cincinnati before he got to Tennessee, and I think the mountain was a little too high for him to climb. I think he's a good football coach. I just think the mountain was a little too big for him.
Was his slogan brick by brick? That was his thing.
That was him.
That's right.
Brick by brick. Yeah.
He wasn't the trash can guy, was he? There was a trash can football coach that was his thing on the sidelines.
I don't know who that was.
I think who was before the current one.
It should have been Derek Dooley because he was absolute garbage. He was absolute garbage. We should have never wasted our time with him. I try not to be derogatory towards too many people, but if you're an ex-Tennessee head football coach, man, there are people who are either going to have good things or bad things and say it's never going to be okay things.
That's right.
So good. So tell me a little bit about, let's see, where do we want to start? Actually, give me a background, how you guys got into financial services. What led you down that path?
Yeah. So, Brandon, I don't know if you want to give a brief intro on you, and then let me know when you want me to jump in.
Yeah. So I got into financial services about 14, 15 years ago, working for a small direct lender. We were doing mainly equipment financing. I focused on healthcare a little bit, mainly dental, and this was kind of high rate stuff, rough credit, and found myself offering higher rates to people with excellent credit scores. And I realized, if I had a great credit score, why would I take this interest rate? And I found myself immediately looking with my moral compass to a bank that had excellent rates. And that's when I started working for US Bank in Southern California. And that's where I kind of got my career going in the healthcare finance, the practice finance world. Worked for them for 4 years in Southern California. And then I moved to Northern California and worked for Citibank and their healthcare group. And a few years after that, jumped over to Wells Fargo and, worked with their healthcare group for 7 years, I believe, and covered multiple different states. That's what eventually.
What years were you at Wells?
Wells was 14 to 21.
Were you there during all the stuff that finally came to fruition after the fact?
I'm not sure exactly what you're alluding to.
It may not have been on the healthcare side, because I know banks are kind of divisional. Right? There was a big thing. There was a Netflix series on it on Wells Fargo, and I think they were kind of
the accounts.
Yeah.
So obviously, I was very aware of when that took place. It was all over the news. With the healthcare group, we didn't really have any issues with any of our clients. But of course, I read about it. There's a couple 300,000 employees at Wells Fargo. And so a lot goes on.
Yeah.
But I definitely heard about it, saw it when it made the news. And that was obviously a big deal. Not good press for us. And we ran into questions and issues with clients sometimes where, they're like asking me about it and making sure that we weren't going to do something like that. It kind of goes without saying with me, but it did come up, certainly. Yeah.
It's sad, man, to see stuff like that happen. The reason I asked, I was curious if that's why you left Wells, because I know several guys that work in other financial institutions now that were previously Wells, and that's one of the reasons why they exited and now work with other banks. But it happens in a lot of different ways. But it's sad when you've got a select few people, and it might even be people at the top or people halfway down or even at the bottom. But when you've got a select few people that don't have the most accurate moral compass, to use your words, and it creates a difficult dynamic for a lot of other people outside themselves, man, for like very, very unselfish reasons, and it's a shame to see stuff like that happen.
Right. Exactly. And then most recently came over to Panacea Financial this year. So that's my quick background on when I got into the financial services.
Yeah. Have you worked in other industries, or has it just been healthcare?
It's primarily been healthcare. When I first got into it, it was all industries. But I kind of quickly realized that I liked lending to doctors, dentists, physicians, veterinarians, people in the healthcare group. A little history on why. I'm kind of a direct person. And when I was younger, I'd get a lot of feedback on being a little too direct. But what I realized with working with, other industries is sometimes they weren't as direct to get things done. But when I was working with doctors and physicians and dentists and veterinarians, and most of them, they didn't have time to mess around. They knew what they wanted. They wanted it quickly, and they were very direct. And I was like, this is great. I'd talk to them for 10 minutes and the phone call was done, and we would move forward on exactly what they wanted to. So I found it being just the most efficient industry. And, I won't dive too far into the differences in credits, but I guess let's just say that most dentists, physicians would get approved. And then there might be some other industries that, might not get approved as often. So yeah, that's what kind of led me down that path.
Yeah, I tell you a secret that I've uncovered over the years is because there are times when I'm very direct and there's times when I'm not so direct, and I try to base that off of who I perceive my audience to be. And one of the things that I've learned is if you're approaching somebody who's a little bit more passive, all you got to do is ask their permission. Because if you say, hey, is it okay if I'm direct? 100% of the time they'll say, oh, yeah, sure, no problem. And then you unload them. You unload on them. So it's I found that to be kind of an elegant workaround, to get the message across and convey it as accurately and precisely as you can without potentially violating somebody's rules for, assertiveness.
Right. Certainly.
And then I'm curious on with you having experience in two different, or in general industry and then in healthcare as well. Mm-hmm. I would definitely think that there would be some things to be said there about, credit rating and financial position. And, obviously, a lot of physicians and dentists are going to be high income oriented individuals. Some better with money than others. So despite high income, some are not in very good financial positions, surprisingly. Others do phenomenally well, very well educated people. But in terms of security for the bank, would you say that one of the reasons why, because there's a lot of financial institutions out there that have verticals in healthcare, and I would hallucinate that one of the reasons why that is because it's a fairly big industry. I think the last time that I checked, I want to say dentistry was 400 and what was it? No, maybe it was $50 billion industry. My information could be several years off. It's been a while since I've done that research, but I would imagine the bucket's pretty big, but I would also imagine that the security that the bank has in financing physicians and dentists is probably pretty good for the most part.
Yeah, that's correct. And you're seeing a lot of new lenders, come to the table to focus specifically on these industries because the portfolios do perform very well. We don't want to call them recession-proof, but if you're in pain, or for veterinarians, if an animal's in pain, you're usually going to get this dealt with, right? If you're sick, you're going to the doctor, right? If you have a massive toothache, you're going to go see the dentist. And I think that those obviously drive it from being a little more recession-proof than, let's just say, a restaurant, for example.
Yeah.
An expensive restaurant, right? If the economy's not going so well and your income's taking a hit, you're probably not going to go to Ruth's Chris for dinner that night.
Right.
When maybe in the past you would. So I think obviously those things speak to why the portfolios perform well. And I think a lot of lenders and folks are kind of catching on.
Yeah. Would you say that the terms are a little bit less strict, a little bit more lenient in healthcare versus general industry? Rates a little bit better, more favorable than general industry, or are they fairly comparable?
Yeah, I'd say the terms are much more aggressive.
Okay.
And I'd say the rates in most cases can be, but I think for a very good business and client in any industry, you can still get an equal rate, I would say. But I think the terms and the structure and how the loans are done and the amount of financing you can get compared to the actual asset is much more aggressive in some of these industries. Mm-hmm.
And I know most people don't go to dental and medical school because they want to get out and own a business. They go because they want to, they're either interested in the science, or they like, tools and technology, and they like playing with gadgets, or, whatever their specific interest is. Some do, I think, go in, with the intention of, being self-employed when they get out. And then the wealth development, opportunities that coincide with that. But if let's say I'm just a guy that's trying to consider what my career path is, and I'm 20 years old, and I'm a junior in college and trying to figure out what direction I'm going to go afterwards. Would you say that looking out into my future in terms of being able to secure the financing that I need to start my business and keep my business going and develop and grow my business down the road, would you say that the landscape in healthcare financing is more attractive than the landscape in just small business?
Yeah, absolutely. And I'm going to defer to Dr. Jerkins here on some of these questions, and he can give his perspective as that person who went to medical school and is a practicing physician, on his thoughts on being a practicing physician, but also why you went down that road.
Yeah, I'm very curious about that as well. So you go to Memphis, or you go to UT, in undergrad at UT?
No, I did not. I went to a small school here in Arkansas.
Okay.
And then oddly enough, made a 2-year detour and taught school out in Arizona. Then went to medical school at the University of Tennessee, and there in Memphis. And then did a residency in internal medicine and pediatrics. So a combined program. It's basically like a double major, if you will, at University of Cincinnati and Cincinnati Children's Hospital. So that's a 4-year program, and then stayed on faculty there for several years, and then recently relocated to the natural state, the great state of Arkansas. So I mean, for me, it's I'm not that creative. I just lived through really frustrating and difficult times as a trainee and early career physician. I could tell you story after story of my own and my colleagues of, at work or at the hospital, we're treated with respect and trust. We're literally treating people that are dying. We're entrusted with people's lives. We're managing that in communication with the family. Yet outside of the hospital, in the financial institutions, earlier in our career or in training, we're treated as adolescents because on paper, we look absolutely horrible. We got tons of debt. We don't have that much of a work history. Maybe our credit history is very thin. And we're not making a lot of money initially, especially in school or in residency, whether it be medical or dental. And the banks won't really care much for you. But then as soon as you get out, you start making a lot of money, all of a sudden they all want to be your best friend. And I just thought that was ridiculous. And things like I could tell you, I was in residency, for instance, had 2 children at the time. I was working 80 to 100 hours a week in the hospital. So I didn't see my kids very much. In fact, one time my son, who was 3 at the time, he said something about, my house. I was like, your house? This is my house too. He said, no, Daddy, you live at work. So, I mean, I was at the hospital all the time, and we were barely making it month to month, probably losing money most of the time if we had any unexpected costs. And so I loaded up on credit cards. I had no real other options. And then there was at one point where we had a couple of grand we needed for car repairs. And I was like, you know what? I'm going to go to banks and I'm going to actually try to get a personal loan to cover these costs for my auto repairs. And what I found was, and this is literally when I work in the ICU. So I work in the cardiovascular ICU during the day. At night or in the afternoon, I'm trying to get financing for a couple of grand. And they're telling me I got to get a cosigner and that they're going to charge me double-digit interest rates. And I did that multiple banks. So it's crazy. That just seems like a big disconnect. And here I am, maybe 18 months away from making, a regular physician's salary. So what we saw was there was a unmet need for an evergreen market, right? There's always going to be new doctors. There's always new medical, dental, vet students that all have the same pain points. It's not getting cheaper to go to medical, dental, or vet school. Right. And so those pain points are not going away. And there's really, there's 4,000 something banks out there. They all pretty much do roughly the same thing. They're not super innovative or dynamic. And so it seemed like there needed to be a creative and dynamic process to really address a very small niche, but a very high value, highly employable, high lifetime value group of customers like my community. And so that's what we did. And we really built every single thing, every product we offer is really backwards engineered to address those issues that we faced. On paper, we have a high debt to income. We have a limited work history. Our hours are really off, so it's hard to connect with us. And we're looking for practice finance. Also can have a lot of hurdles and non-common sense, arbitrary rules by the big banks that interfere with our ability to expand, acquire practices, fund equipment, things like that. That we really, our whole company we're for doctors, by doctors, and our website. It's not just like another bank that has a healthcare vertical with some people in white coats on their website. Everything's built by doctors with unique underwriting specifically for our market. And like I said, I'm not that creative. We built these off of pain points that we lived through and we thought needed to be changed. And I think that's really honestly I'm surprised it took this long for a solution that is nationwide to come up.
Yeah, I want to get into some more details about the services and what all that stuff looks like. But back up, how long ago was this that you started Panacea?
We've been working on this for years, but our first loan was in November of 2020. So It's a culmination of years and years of work. Yeah. But yeah, I can remember our other physician co-founder's name is Ned Palmer, also practicing. I'm still practicing. We see patients. I remember sitting on our house, sitting in my house as an intern, which is your first year out of medical school, basically stressed out, and bemoaning our financial woes and kind of our ability to interact with banks and be treated with respect and be treated like adults. And that was back in 2014, 15. And that's really where the idea started. We formed the company and have been working on it really ever since, trying to get it off the ground. And eventually we were able to. I'd love to eventually also talk about getting Brandon on board and the amazing job he's doing and what we're building here from a nationwide practice finance solutions that we think are common sense and extremely different from what's out there.
Yeah, I'm really intrigued about where you are in your journey, because it's a lot of people have ideas, right? I can't remember the specific quote, but there's a great quote that said there's more dead dreams in a cemetery than, anywhere. There's a lot of people with good ideas. There's people that go through hardships, and there's people that think to themselves, there's got to be a better way. There's just got to be a better way. And I'm always inspired and intrigued by people who don't just have the idea, but they say the idea is not enough, and they actually take a step forward, because that's what I would call like faith in action. Like, you believe in this thing. And I tell my clients all the time, I'm like, you say you believe in this thing. You say you believe in it, right? You say you believe in fee for service, high quality patient care, high quality patient experience, top-notch technology and all that stuff, and people want it, and you're going to do that in this market where nobody else is doing it. You say you believe in that, prove it.
Yeah.
You know what I mean?
Absolutely.
Unless you take action towards the attainment of that idea, you don't really believe it. You like it. It's really sexy, and it turns you on, but you don't really have conviction in it unless you put yourself at risk.
Totally. It's risky, right? You got to take risks to be able to reap that reward of those ideas. It's a grind, like any idea. It's going to take a lot of time, a lot of work, a lot of effort every day, working on that. I remember, again, I can think back to 2015, 2016, Ned, another physician co-founder, and I, on our off day. Remember, as a resident, we get 4 days off a month, and they can be a random Tuesday here, a Friday, a Saturday, and I would rarely see my family. I remember us going on the weekdays and going to banks with our pitch deck, our business plan, and trying to pitch banks on a for doctors by doctors company. Now, looking back, it's pretty funny to think about. On the other, especially talking to Brandon, being on the other side of the table as a bank and seeing these two guys that look like they haven't eaten in 2 weeks or maybe even slept, and who've not worked at a bank ever, and be like, who are these guys? And what are they talking about? This is ridiculous. And it's a big change from anything they would have been doing previously. Mm-hmm. So it was a pretty lofty asks that we had of these folks. And, it took us a long time of hard work to get it off the ground and get this amazing bank partnership that we have with Premise Bank, who really has given us the ability to deliver on these unique products and full product suite of services nationwide.
Very good. So what did, just out of curiosity, like, let's say it didn't work out the way you wanted it to. Okay. All right. Humor me for just a moment.
Yes.
Because I think people need to appreciate, I hate to put it this way, man, but it's almost as if entrepreneurs are under such attack, by mainstream, because it's like, there's a great quote that says, if you work for more hours than you get paid, eventually you're going to get paid for more hours than you work, right? People don't see the 80 and 100 hours a week and the time away from your families and your child saying, you live at work. Mm-hmm. They don't see that. That's sacrifice. Mm-hmm. So what they see is when you're in your mid 40s and you're vacationing to Paris, and you're working 12, 16 days a week and you've got great work-life balance and all this kind of stuff. And it's kind of like, that's what they want, but are they willing to climb through the mud to get there?
That's right.
I know Brandon knows what I'm talking about too, because when you're in sales, and I realize you're in financial services, but a big part of what you do, I would imagine, is selling financial services, right? Enrolling and influencing. It's a numbers game. There's a lot of, I can remember pounding pavement and going door to door and handing off flyers, sleeping in my vehicle because I couldn't afford hotel rooms, being gone weeks on end, all to get to, a point where I have a few passive streams of income and I'm trying to accelerate that and slow down my direct income a little bit. And, there's a lot that goes into getting there, man. And you put a lot at risk for the opportunity to experience that the vast majority of people just aren't willing to do.
Yeah. I didn't mention the job before my financial services job was door-to-door insurance sales.
Nice.
100% commission. And It was door-to-door business. And it was one of the first jobs I ever had as a young, naive person who wanted to go make it happen. Yeah. And, if you have a will, there's a way. And I look back going, there's no way I could go do that again. I guess if I had to, I would, but it was pretty intense and, crazy to admit, but yeah, there were some times I did sleep in my car, and there was weeks I made $0.
Yeah.
So, after going through that, working for some of these large banks and doing sales, it's in my mind, it's a lot different than the way I think a lot of people, envision sales. So.
But see, that's the people I want. I want the people that, climb through the mud and don't complain about it. And they're still climbing through the mud. The people that climb through it for a few weeks and say, man, this is more work than I thought it was going to be. And they give up. I'm like, that's not who I want on my team. You know what I mean? Nothing against them. Nothing, no judgment, no criticism, nothing. But I think there's something very special to be said about the character of people that are willing to persevere. That's a character trait that just not a lot of people possess.
Yeah. And it's on the list of reasons why I joined Panacea.
Yeah. Yeah. I know I annoy people with this. I talk to my coaches about it all the time. And I talk to my clients about it a lot because they're calling patients, trying to get patients back on the schedule, and they don't answer and they don't call you back. And you've ran into the same thing, reaching out to leads. They went to the website and they submitted an inquiry and you started following up with them and they didn't respond or call you back. I'm one of our national coach trainers, and one of the coaches that's going through our training program reached out to me and she was like, well, when do I follow up with this doctor? Because I don't want to annoy him, and I was like, I totally understand where that comes from. Like it's certainly, it's not in your heart to desire to get on someone's nerves. Yep. Right. But if you look but to be honest, you don't have enough information to say that you're getting on their nerves or not. You know what I mean? Unless they come out and say, hey, you're getting on my nerves, you don't have enough information to come to that conclusion. So you have just as much information that says keep going as you do that says stop.
Yeah.
So why not pick the choice that moves you closer to the outcome that you're pursuing? and there's a statistic that comes from the National Sales Executive Association is pretty outdated at this point, but I always tell my coaches and clients and everything that to strive for 12 to 15 touch points. Like, unless you've reached out to them and like touched them 12 to 15 times, you're not done yet. And the reason is because when you look at the statistics and the probability, I'm a statistic nerd, man. Like if I can read it in the numbers, it's true. It's just,
yeah, I'm right there with you. Absolutely.
And the probability, it says, I can't quote them directly off my head, and I'm not going to take the time to look it up, but it says like the overwhelming majority of salespeople never follow up more than 2 to 3 times.
Right.
Over what, like 90+% never make more than 3 phone calls or text or whatever. But 90+% of all sales are made between the 5th and the 12th contact. You know what I mean?
Oh yeah.
So unless you've touched them at least 12 times, I mean, you haven't even gotten into the sweet part of the opportunity yet. You're still very much on the front side of that curve. So minimally, just get to that number. And I can remember when I was doing the door-to-door and the cold calling and all that stuff, I would send an email. Like week 1, I would call. Week 2, I would send an email. Week 3, I would stop in the office. I would get a business card. Actually, that's how I got the email address. So I would call. Next week, I'd stop in the office, get a business card. Then the next week, I would send them an email. And then the next week, I could also get their website, find their Facebook, send them a message on Facebook. And then over the 12 to 15 times, I would have, had 4, 5, 6 different platforms, mediums that I could contact them through. And man, I did that religiously over and over and over again. And I can remember and this is why you shouldn't give up. I've got a client, I've got two clients to this day, been with me 8 or 9 years, that when I went back and looked in my CRM data to see how many times did I follow up with these people, it was like in the 400s, like emails, texts, stop in their office, Facebook message, phone call, over 400. And eventually they contacted me, say, okay, I'm ready to get started. And they've been clients of mine for 8 or 9 years now. So if I'd have given up at 2 or 3, that would have been, 8 or 9 years worth of mortgage payments, 8 or 9 years worth of, reinvesting in my business. You know what I mean?
Yeah. Yeah.
But you got to see through that stuff, man. And when I meet people like you that do that, it's refreshing to know there's other people out there like that.
Yeah. I mean, it's like when, Michael and Ned told me the story about how this got going and how many times that they tried and worked on it and over how many years. And I'm just like, hey, I'm so glad that you guys kept trying, kept pushing until you finally found a path and an answer to get this thing off the ground. So yeah, you got to be relentless.
So you're still a practicing physician. You're in pediatrics?
I do internal medicine and pediatrics. So I have both board certifications. Yep.
Okay. And then the other co-founders are also physicians?
So we have 3 co-founders. 2 of them are physicians, and we have a money guy, as I like to call it. But Tyler Stafford's our other co-founder. He was in investment banking for around a decade or so, and it just so happened also to be my college roommate. And that relationship really helped us get this off the ground. So 2 of the 3 co-founders are still practicing physicians. Okay.
And then what was like what was step 1? I mean, you guys just scheduled a call and said, hey, I got an idea. What do you think?
So it's funny. Again, we have been, just like you said, you were talking to anybody and everybody you possibly can, pitching them on this. We're going to banks or other organizations, anyone I know in finance. I'm talking to, and Tyler happened to be in Cincinnati on a work trip and stayed at our house. This is several years ago now. And I pitched him on the idea. He says that's the first time he heard about it, but I'm pretty sure I talked to him about it a couple of times before. But we had pitched him on the idea, and His job essentially was covering bank stocks and meeting with bank CEOs and CFOs across the country, analyzing their banks, understanding areas for growth, inefficiencies, and that type of thing. And then a few months later, he essentially texts me and says, "Hey, I got a really close friend of mine who's the CEO of a bank. He's looking for verticals that are creative, innovative, and dynamic. And we'd like to see you're interested in partnering up, you and Ned." I was like, absolutely. Actually, I was between patients. I looked at my phone between patients, saw he texted me. I just replied, "Yes, I'll call you after clinic." I had to put my phone away, see patients. And then afterwards we got on the phone. And really, ever since that day, I mean, it's been hitting the ground running. I can't even tell you how many times a day I talk to Tyler and Ned. Really that got the ball going. Eventually, again, like I said, we initially launched with our first loan in November of 20. And that was really so we have two main sides of the house, consumer and commercial. On consumer, we started with what's called a PRN personal loan. So in the medical space, PRN's a Latin acronym we use all the time. Means as needed. So it's a messaging that's kind of baked into the product itself of what it is to the specific market. And it's a personal loan that's completely unsecured that we even lend to fourth year dental or med students, and with no credit score minimum, no DTI calculated, no cosigner, less than half of a credit card that we can give or fund in as little as 24 hours. And that was a way to give a lifeline to these folks who have so much demanded of them and their training, and they had nowhere to turn but toxic debt, to give them that opportunity. Obviously, it helps us by getting in early with that relationship of their other financial products they might need down the road. We also, just to be frank, a lot of our customers for that product are in practice independent. We loan up to $75,000 as little as 24 hours, less than half a credit card. People love that product. So that's really what we started with. And then we branched out to student loan refinance. There's a lot of issues there, especially with doctors. A lot of companies calculate debt to income, and then you get a bad rate, or they put a cap on a maximum amount. And you guys, this, working with a lot of dental professionals, they can have $400,000, $500,000, $600,000 in student loans, and they can't find one loan servicer that's going to do all of that. So we wanted to be able to offer that full suite of consumer products. We also do free checking, high yield savings. But what was always important to us is to be able to offer the full suite of services, which had to include a good commercial product and practice finance. And I'll let Brandon talk a little bit about the story of getting that off the ground for us. But we brought in Brandon, and I think he's demonstrated even tonight some of the qualities that we love and why doctors love working with him. Is that he's down to earth. He's common sense, which is our whole thing, is common sense lending for this high yield group. And that moral compass is extremely strong. As you mentioned, doctors love being direct, and they don't want a lot of BS, and I think that's one thing that we don't want to waste people's time. And we want to be very transparent about what we do and what we don't do. And Brandon is just fantastic at that and has proven that. And the massive team and operation that he's built and been building with us has been fantastic.
Yeah, I've only talked to Brandon, I don't know what, 2 or 3 times.
Yeah.
And then how did we meet? Through Jonathan Miller?
Jonathan Miller.
Yeah. And we've only talked 2 or 3 times, but your description of him is exactly how I would describe it. It was very professional, to the point, direct. Either I can do it or I can't do it. And I was just like, why spend 15 minutes on the phone? We can get done in 2.
Absolutely. Yeah.
That's great. That's exactly what I need to know. Cool. Talk to you tomorrow. So yeah, it's been a very, very positive experience. He was, and a lot of the things that I run into on my side of the business is obviously we've got a lot. I do a lot in the merger acquisition space. I do a lot in the quite a bit in the debt restructure. A lot of clients need, or at certain times in their career, it's a proper time to look into debt restructure and free up some cash flow so we can reinvest. Student loans are a big one there. And then second and third locations, and obviously the pressure that a lot of dentists are under with DSOs. I don't really know what the landscape looks like for medical now, but I know what dentistry is going through now. Medical went through probably 20 years ago. And so dentistry is really kind of seeing now, if they don't take control of their industry, that's where it's headed. So we need more progressive, more entrepreneurial people. Because I mean, in 10 and 15 years from now, there's going to be two types of dentists out there: the dentist that works for other dentists and the dentist that employs other dentists. And depending on which one of those you want to be, those are the decisions that you need to be making now, to position yourself there. And financing is a really, really interesting variable in that equation, because when you choose your financial partner, like you're going in business, when you choose your financial partner, you need to be aligned by somebody who understands your organizational goals, right? Like, I'm a single location dentist and I want to own 50 locations in the next 10 years. Okay. Probably not going to get there through traditional financial services. It's probably going to require, PE to make that kind of a progression. But that's your, top 5%. There's a ton of folks out there that just want to get to 3, 5, 7 over the next 10, 15 years. So it's a lot more moderate risk for the bank. And then some banks are very much supportive of that and some not so supportive of that. So it's almost as if the entrepreneur and the dentist is limited to some extent by their financial arm. You know what I mean? Because the more practices they acquire, the more risk is now associated with the whole deal. They've owned one location pretty successfully, but they haven't owned two. They've owned two, but they haven't owned three. Now we've got multiple associates being brought into the equation. Because I get it from the bank's perspective. Do you guys take all of those variables into consideration? How does what's your just overall philosophy around how you partner with your clients?
Sure. So we went from, I'm just kind of keeping the conversation going here, the three owners, how they started Panacea, and now we're on how we deal with up to 3, 5, 7 offices.
Mm-hmm.
Okay. So yeah, we're going to take into consideration all those variables. We want to make sure it, depending on how many offices that they have in the beginning or when we start talking to them, and then where they want to go. My biggest goal when I'm dealing with a client is to make sure that I set the right expectation. So when somebody comes to me and says they have 3 offices and they want to have 10 in the next 3 years, well, then we have to be very realistic with them and talk about, well, we would love to help you grow, but at what pace, right? And, some of the language I'll say is, we will help you grow as fast as you can pay us back, right? Because we don't want to get them too leveraged. And so we got to have a real conversation. And sometimes other banks won't have that real conversation, and they'll just say, yes, work on the next practice. And then as soon as the doctor comes for practice number 4 or 5, the bank's like, oh, well, you're growing too fast, pump the brakes. And then they're kind of stuck. So the first thing I do is really look at the long-term plan on how fast they want to grow. And then I walk them through a scenario of how that could be possible, with Panacea and what that looks like. And we will take into consideration all of the variables that you mentioned. And the variables get greater as they grow, right? So maybe office 1, 2, and 3, we will pay attention to the associates and making sure that they have worked there for a while or what have you. When we're looking at offices 7, 8, 9, and 10, we may start looking into the actual contracts that they have and what those contracts look like. Because if these associates have an easy way to leave, and that all happens at once, that could be very detrimental for some of those offices. And if there's one owner and there's 10 locations, obviously that owner can't be in multiple locations at the same time. So that could really hurt the revenues. And so, we'll really dive into the details of the associates and how they would stay on.
Now, do you guys just work with private practice owner operators? Are you working with, any like corporate DSOs?
No, not right now. Just private practitioners.
Okay. And is your book primarily healthcare oriented people, or are you Gen Pop too?
We're 100% in the healthcare field. Yeah.
100% healthcare. Okay. So tell me, you mentioned a PRN loan. And so I can certainly see I can certainly see the benefit of that product for a lot of people. You've got let's see. I know that you've got acquisition loans. What are some of the products that you find that, or what? Actually, tell me this, because one of the things that you've built Panacea on is like creative, dynamic products, correct?
Mm-hmm. Absolutely.
Okay. And so I would say that's depending on how creative and dynamic that, that's probably your competitive advantage against a lot of the bigger banks. Right.
Yeah.
What does some of that look like? Like how would you define what makes you stand out in the marketplace?
Can I talk a little bit about the consumer and the student loan refi, and then Brandon, maybe
Sure,
you can kick it over to you on some of the commercial products. But on student loan refi, again, I think we're the only bank that I know of that does not take into consideration your credit score or a debt to income ratio when we price those interest rates. Actually, the interest rates are right there on the website and they're competitive with everybody else. But we understand, as far as the credit worthiness goes, the way that typical financial institutions have assessed credit worthiness on these consumer products like student loan refi, it's very much set in the old way, which doesn't quite apply to this population. So that is hugely beneficial. And again, there's no co-signers there. There's no maximums that we have at all on our student loan refi, which is very helpful for a lot of borrowers, because once they apply to one of the other institutions and they put in their total debt servicing, like their interest rates go up that is offered to them. We don't do that. We don't nickel and dime. We don't bait and switch. It's right there on the website. You either qualify or you don't. And basically you got to be a practicing doctor making money as either in practice or in training, because in training, we actually offer student loan refinance as little as $100 a month. So those people can afford it from a cash flow perspective. And they want to actually start to not have that interest build up so quickly. And then, I'll let Brandon talk a little bit more specifically about how we're different on the commercial side. But those two things on student loan refi, no one else is doing. And the other thing is, if you want to acquire a practice, let's say, and you go to Panacea and you're looking to get financing for that, we can also help you with your student loans at the same time as we help you with your commercial loan. I don't really know of any bank out there that's able to do all of that in a singular relationship that offers competitive pricing on all of it. And it saves the doctor time, right? I mean, you even mentioned it, just how quickly that we want to have conversations. We don't have a lot of time. And if we have a relationship we trust, having all of those suite of services in-house with the same lender is huge. And we're not selling your loan off to some other servicer. It's all in-house. So we maintain that relationship going forward. And the last thing I'll say is every single customer, whether it's on the consumer side, commercial side, whether you're a first-year dental student making no money and you just open a checking account, or you're a practicing orthodontist and you just acquired $1 million practice, you get your own personal banker. We call primary care bankers. And so most of us, when we get done with work, the bank's closed. So we can't find anybody that knows who we are. We can't get a hold of anybody. You have access to a concierge banker between patients. You have their cell phone number, their email, and you can move wherever you move geographically after that. You can maintain that relationship and they can help you with any of your products, or even help you answer questions about other ones you might need. And then if it was, let's say, a night and you're on a night shift, you're on call and you want to talk to someone from our bank, we have 24/7 actual human beings, live customer service that can answer your call and try to troubleshoot if you have any technical issues. Again, all of that is engineered for this specific group. I don't know of anyone that offers that full suite of services in one singular relationship, even to the person making no money, to the person making millions. We think all of those customers deserve that kind of relationship. And from a business perspective, obviously, we understand the value, the lifetime value of that customer, and getting in with them earlier than our competitors know how to do. That's huge for us. And then, Brandon, I think it's amazing what we have on the other side of the house, how we've been able to help a lot of doctors that didn't have good common sense options at some of the other banks.
Mm-hmm. It doesn't sound like there's any private equity involvement unless it's just from shareholder capital injections. Is that right?
There's no private equity. That's correct.
No private equity. This is just my curiosity. I'm fascinated by the banking industry because there's the top three wealth development strategies in this country are investing in your own business or another operating company, real estate, and financing deals. Those three options have created more millionaires in the United States than anything else, all others combined. Well, financing deals is being the bank, right? And so you've kind of taken that to a whole nother level, like you actually built a bank. So I'm like, man, I wish I knew what you knew in that space. Like, obviously you had to have gotten, how did you get to a point? And I'm assuming this is where you partnered with your other bank.
Mm-hmm.
Yeah. Because in order to issue your first loan in November of 2020, that money, you had to have money to loan.
That's right.
Right. Yeah. And then you get paid back over a period of time. So you go from, if you got, $50 million in your bank account and you loan out 25 million, now you got 25 million and the other 25 million is going to make you 5 million, but you're not going to get it for 20 years.
That's right. That's right.
10 or 12 years. So it comes back in slowly. So is that why you partnered with, what was the name of the game? Premise Bank?
Premise. Yep. PRIMIS. They're based out of Richmond, Virginia. They're publicly traded. Their ticker, I think, is FRST. And Premise means first in Latin. So that's the etiology of the ticker name. But yeah, I think you hit it right on the head. Like, we wanted to go big, right? We want to be able to address doctors' concerns nationwide, which required proper amount of capital. And that's where our bank partnership is super helpful, because, they're through their capital, and a lot of banks, since COVID, are fairly liquid, have a lot of cash that they want to put to work, which is, that's where we come in as Panacea, having an innovative way to address a market inefficiency, but also help the bank, grow and put their money to work. And that's kind of how the relationship works.
And I noticed also, and this is why I more or less concluded that there wasn't any corporate equity involved, because it seems as though you guys are still very much, pushing the buttons and pulling the strings. Because
right.
I think every business kind of starts with the consumer in mind, right? And customer experience and customer care and 24/7 customer support and all that kind of stuff. And then as the margins get more important and the pressure from the top comes down for wanting their money back in returns, the pressure to cut costs goes way up. And then you wind up on a phone tree for 30 minutes. It's kind of like, man, we're so far from where we started. And everything that you just described about where your priorities are, not once did like the bottom line come up. So it's like, it's almost as if, and correct me if I'm wrong, I know you probably want to make some money,
that would be great.
But it doesn't seem to me as though that was the motivating factor. Even when you were in clinic in residency and this idea came up and you didn't have any money, and then you guys decided to go down this route, all the evidence says, I don't have any money, I can't start a bank.
Mm-hmm.
The thing that requires the most money of any business, and it doesn't sound to me as though the motivating factor to get into it was making money. It was, solving a problem.
That's right. Yeah. For me, the last thing I was going to do was cut back clinically, which I have. Obviously I've cut back clinically and seeing patients. The last thing I was going to do is sacrifice that to try to push more debt on my community that doesn't need that, right? The best kind of debt is no debt at all. But unfortunately for our community, we can't avoid it in a lot of ways. And we just needed a fairer and healthier shot at it. I know that sounds hokey and potentially people don't believe me, but that literally is why we did all of this, because there was a kind of a fairness and justice issue. It seemed like it was unfair the way we were getting treated and the options we were given, and someone had to do it. Why not someone from within our community? But obviously we need the margins with the mission, right? That's always that balance that you kind of mentioned.
I like that. That's good.
Yeah. But at this point right now, it's a very, like you said, as far as a business goes, I think we got a business model that is sustainable and viable and profitable, but at the same time, able to execute on the mission that really started the whole thing.
Interesting.
It's spot on. Bankers will always say they're only as good as the bank that they work for, or the credit policy. For me, it's always been, as I alluded to earlier, you got to be able to set the right expectation. And sometimes you can't do that. And, coming to Panacea, being able to have products that make common sense that you can take to the market to solve problems is very valuable. And, when I first joined, or we were speaking about me joining, a lot of the conversations were around that, right? There was no conversations around, comp. It was all around what are the products that we're going to be able to offer, and, how are we going to deploy those, and what are the guidelines for those? Because for me, if I can't bring something very helpful, let's not call it competitive. Let's call it, helpful to the doctor. It wasn't going to be something that I was going to be interested in, but it was quite the contrary. And it's been a blessing to come over here with the products that we have to be able to offer them and talk about them. So I work a lot, but I have a lot of fun doing it. So just wanted to kind of interject that about, what this group's all about.
Yeah. It seems as though, my experience with you, Brandon, it seems as though you enjoy doing what you do. It's not kind of a trend. Correct me if I'm wrong. I don't think that you guys are trying to create a transactional business. It seems to me as though you're there to offer support and offer help. And in my interactions with you, it seems as though it seems as though you're passionate about what you do. Like, you like the financial space, you like the numbers, you enjoy it. It's fun. It's entertainment, to some extent. And so if you're anything like me, man, I'm very much the same way about my business. And I don't want to, I don't want to do anything that I'm not passionate about.
Yeah.
I've learned, and this is why I think you guys are going to be very successful. I know it's, early, but I think you're going to be very successful doing what you're doing, because you're not chasing the logic. The logic says, man, you got to put profit first, right? Matter of fact, there's a book on my bookshelf right now. It says Profit First. It's a great book, but it was given to me by a CPA.
Go figure.
Yeah, and it's a great book. Makes a lot of sense. A lot of logic in there.
Yeah.
But you hear people say things like, chase your dreams, not money. Do something that you're passionate about, and you'll never work a day in your life. It's easy to say that. But if you've experienced it firsthand, and I'm grateful enough and blessed enough to say that I get to do that. Like, I don't feel like I work. I could do this until 10, 11, 12 o'clock tonight, wake up at 4, do it all over again. And I don't get burnt out on it. I don't get exhausted from it. Like, I enjoy being of service. I enjoy solving problems. And it's kind of like, because I'm so interested in it, I think that's part of what has me be more effective in my role and better at what I do than I would be if it was not something I was so passionate about. So I think you guys will be ahead of the curve for a while, man, because I'd probably coin you a little bit maybe as an underdog, against the bigger banks, even though you've got a partner bank to help, provide funding and that kind of stuff. But I mean, getting the brand recognition in the marketplace, and I mean, really being a major player in terms of practice acquisitions, and kind of being the first thought, that comes to mind for a lot of the professionals around the industry. I'm excited for you guys, man. I think you're doing some good things, and I think I like both you guys. I think your personalities and where your heart is and where your intentions are, man, is very good. I think there's a lot of good things in your future.
Appreciate that. And we haven't even talked about all the products, right? So we haven't even scratched the surface.
Oh, I know. After what we get to the practice acquisitions and the PRN loan.
Yeah.
So do you guys have an SBA product, mortgage?
No, not right now.
Okay.
Primus, our partner bank, has an SBA product, yes, but we don't have one designed for Panacea right now. But with that said and understood is, we can do anything that an SBA would do conventionally. There's just some other guidelines around it. So I think that's another reason that it makes us unique. We're happy to, find a strong deal. And if it's a ground up or an acquisition of a building, or, SBAs do startups, or if it's a startup, we're more than happy to look at that and offer a conventional option.
Okay. I'll run into that one quite a bit too. There are a lot of banks that want to do the startups. And then there are a lot that will do acquisitions, but not startups. And it's hard to find a financial solution that's kind of the end all be all that can virtually handle any situation that arises.
Yeah. I mean, I think our goal at the end of the day, and Michael talked about it with the PRN loans and helping doctors, physicians, and dentists when they're young and actually, and need funding and can't go get a conventional loan, is to help them at that stage. And then anything that comes after that. So, if we're helping a fourth year dental student with a small loan for whatever, and they come back to us and say, hey, look, I'd like to start a practice, or I'd like to buy a practice, we should be able to offer a product to help them. We don't want to help them at that point and then, pass them to somebody else. So we spent a lot of time and effort in creating the startup and acquisition products to help those folks as they transition from, school, residency, what have you, and want to get into ownership. Not everybody wants to, but for the folks that do, of course, we want to be able to do that for them.
Yeah. So if I were to buy a dental practice, and I'll throw a couple of different scenarios at you. If I were to buy a dental practice and wanted to acquire, what's that?
Softballs.
Yeah. So if I wanted to buy a dental practice and the real estate was available for sale too, you would finance the acquisition on a 10 to 12 year note, competitive interest rate, et cetera. And then the mortgage on the real estate portion would be financed through Premise.
No, through Panacea also.
Okay. So you could do the commercial real estate loan.
Yes, absolutely.
Okay.
Yeah.
Okay. Very good. Very good. What if I wanted to buy a practice, and I don't know how this would work with you guys. Let's say I wanted to buy a practice and I went to another bank.
Okay.
And the practice was valued at $1.3 million, but it only collected $1 million in the last 12 consecutive months, or even the average over the last 2 to 3 years is $1 million. You look at fair market value, and let's say I go to another bank and they'll finance me up to $800,000, $900,000 of the 1.3 or 1.2, whatever I said. You mentioned an unsecured personal loan earlier. Would you float me a loan, like a bridge loan, to cover the difference between those two? Or does that exceed the capacity of that particular product?
Well,
I think you said 75,000.
Yeah, but because we can offer both, right? And we have the same credit department, we're going to look at the request as a whole. And if we're going to lend $1 million on the practice and then 75 personally, well, why wouldn't we just lend $1,075,000 for the business loan, right? So we'll look at it as a group. We won't just kind of throw products at it, if you will. So to answer your question, we would look to lend as much as the doctor needs to buy the practice after we, did our analysis on value.
And can you?
I know it's kind of a banker answer, but
no, that's fine. I'm trying to think of some very unorthodox scenarios. Because you'd be surprised at how many different little things pop up, and it's like the doctor really, really likes this bank and this banker. They don't want to go to anybody else, but that bank won't loan what they need to acquire the practice. So it's kind of like, well, if this bank's if you're going to get the $200,000 or $300,000 from this bank to cover the difference, if I'm them, I'm going to want to finance the whole thing, because now I can collateralize. I've got the whole thing. So it's just there's going to be different different scenarios everywhere. And it's like, you can't make everybody happy all the time. So
Right.
And so there's got to be bend somewhere.
Yeah. Go ahead, Mike.
I was going to say, Brandon, could you comment a little bit on that, like in his scenario about the acquisition, about what he would expect from a decision on an approval after he submits the complete package, and or an acquisition financed through Panacea versus some of the other folks out there that I won't name and give free publicity to?
well, certainly. But John, what was your question?
A lot of questions thrown at you. Sorry, Brandon.
No, that's okay. That's absolutely fine. John, what was your? Let's
say I've got a doctor who wants to buy a practice, and they're very particular about their bank. They want to go with this particular bank. All their checking is through this bank. All their other loans are through this bank. But this bank will only finance X amount on a practice acquisition and not the whole thing.
Okay.
But they don't have the cash to cover the difference. And the owner's not willing to carry a note or do an earn-out on the difference. And so I need $300,000.
Yeah.
In order to make the deal work.
Yeah. So, the unfortunate answer is we'll probably not be able to assist because that other bank has a lien. Now, if for some reason that other bank doesn't want to be in first position lien, then absolutely we could probably figure it out. But just giving you the most realistic answer, it's going to be tough for us or anybody to say, sure, here's $300,000 on top of the loan you're getting from the other bank, and we'll be in second position lien on a practice loan. So those are very tough to do. We get quite aggressive, and I usually say when we're talking about what can we do and what can't we do, and why we can't do it, I think the best way to describe it is if I can explain it to a doctor on why we can't do it, and it's a common sense answer, and they actually end up agreeing with me, I think that's the best way to say how we describe what we can and can't do. If I come to somebody and say I can't do this deal and give them some percentage, right? That's not too much of a common sense answer. That's a line drawn in the sand, and we try not to draw lines in the sand. Obviously, we have to have our policy, and we have to have guidelines that we follow for good reason. But there's also many reasons why those lines can be broken, and we want to make sure that we have the ability to do that. So we can get quite flexible, but it has to be with good reason. It has to be able to be explained properly.
Very good. What are some of the other ways that you would highlight in terms of how you've differentiated yourself and made Panacea unique?
I think the scenarios I'm giving right now about how we're able to kind of cross some of those boundaries and those lines in the sand will make us unique. Some simple examples would be, let's just take a startup product, for example. If somebody came to me and needed $750,000 to start a dental practice, the answer would be yes, we can look at that, and we can take that credit in and review it, and provided they meet the guidelines, absolutely approve it. And we wouldn't be breaking any of our guidelines, if you will. So that definitely makes us unique to what I've seen in the market. Our restructure of the loan, our payment structure of the loan. If a doctor wants a certain repayment structure that's unique, we can usually figure that out, right? Sometimes they want to have certain months interest only, and then principal and interest payments, and the schedules can be unique for whatever reason they have. We can usually make that happen. We don't have just hard rules on what those structures are. On acquisition loans, I'd say probably the most common thing you'll hear is when a doctor goes to a bank and asks, how much can you lend on this practice? They will usually give a percentage of revenues. That's very, very common. Have you heard that a lot?
All the time. Yeah.
Somebody says 85, 90% of revenues.
That's basically general rule of thumb.
Yeah. So generally, right. So, like I said, we have guidelines, and some of that language is in there, and there's other ways that we'll value a practice from a bank's perspective. Remember, we're a bank. We're not appraising these practices. So we have, just certain way that we look at them. But if the practice is priced really high for good reason, and the person buying it is a very qualified individual that looks excellent on paper, we're going to make every adjustment to meet their needs and go above what that percentage may be. So I never really want to promise that we could, go to a certain amount, but I think that the best takeaway here is if there's good reason for the practice being priced so high, and the doctor maybe needing more money than the practice price to upgrade it or do this or do that, we can do those deals. Yeah, we absolutely can. They just have to
I don't like that whole percentage of revenue and all that kind of stuff, because the top line means very little. How much the business collected in the previous 12 months is probably the least important number on that P&L.
Yeah.
Like if I buy that business, I'm not buying $1 million worth of revenue. I'm buying $550,000 of discretionary earnings.
Yeah.
You know what I mean? It's like, what's the actual tangible cash flow from the business before I pay taxes and interest and take deductions? That's the number that's more important, because you might collect $500,000 more than me, but I'm taking home 25% more than you.
Yep.
You know what I mean, which business is worth more?
Right.
Which business is more financially, stable? Which business is more eligible for financing and a less risk for the bank? The one that's got more cash flow. So it's when you look at that top line number, man, that skews things a little bit. So and it confuses a lot of people, really, because back when everybody was talking about the typical, because I can remember back when the general expression was that practices are selling somewhere between 60 and 70% of the previous 12 months collections. And then it was, 70 to 80, and then it was 80. Now it's 90 to 100. Now I've seen them 110, 115. Yes, any valuation you can take and put it in the context of what percentage of revenue is the purchase price. You can do that regardless, but that's not how you calculated the purchase price. You didn't come up with a percentage and multiply it, and then here's what the practice is worth. You started with cash flow. You started with EBITDA. You started with seller's discretionary earnings. And then you looked at probably historical transactions and where the practice is located and all that kind of stuff. And you came up with the multiple from there. And that's where the value came from. So it's all cash flow.
Absolutely. And you said a word: discretionary earnings, discretionary expenses. I think it's a big topic, and something that, I definitely want to highlight. Working with other banks, digging through the expenses on a tax return to figure out what are discretionary. Mm-hmm. A lot of banks, they really just don't want to look through those. If they're their business expenses, they're non-discretionary, they are what they are. At Panacea, we definitely are going to look through every single one, and we will move over into the old income column. And if they are truly a discretionary expense, right? If you see an auto expense for $48,000 and the guy lives 10 miles away from his office, please explain to me the business expense that is. I mean, sure, he's running it through his business, but I don't believe the expense is for the business, and those things should be added back. There's plenty of expenses that you can find. So
even continuing education, I would say, is discretionary, because if you're buying my practice, we're both going to spend money on CE, but you may not spend the money on the same CE that I'm spending it on. I may spend a lot more.
Right.
Travel. I mean, I might have taken my 8-year-old son or 15-year-old daughter and 5-year-old daughter might be, shareholders in my business. And we took a business meeting to Hawaii last year and talked about our profit and loss statement and financial projections for the following year. And that's good. I mean, that's going to get factored back in as well. So, I mean, there's a lot of it. You're right. There's a lot of discretionary expenses that come out above the line that it's very easy to just skip over that and go to the bottom line and say, and that's a very global way of looking at it too, because I can skip over that and go to the bottom line and say, well, if they qualify at this level, then if I add those expenses back in, then they'll really qualify. So it's less risk for us. But that's not really being of service to the person that's trying to qualify for a loan. You know what I mean? Plus, you're probably going to base their credit. You're probably going to base your rate on what they're lending, on how secure that loan's going to be for them. It's probably going to be a factor. There was something else in there I was going to mention. Shoot, if it's important, I'll remember it. But yeah, it's not as straightforward as that, man. It's you've really got to dig in and see what's actually there, because if I'm going to buy your business, the most important thing to me, because the vast majority of practices across the country are, owner operator, right? Private practice, single dentist, owner operator. If I'm buying your practice, the most important number to me is how much money is available after I buy your practice and the transaction is complete. How much money is available to me to cover the expenses, pay my mortgage, feed my children, etc. How much money is left over? So, I've cut out the CE. I'll cut out the travel. My car's paid off. A lot of those expenses we can wipe out, and that's going to inflate cash flow, make it look a lot more attractive on paper. So yeah, that's a good point, man. That's a really good.
Yeah.
Okay. Where do you guys see yourself heading? Right now, you're kind of connected to Premise Bank. When your bucket gets big enough, do you guys see yourself separating from that and having your own bucket, or do you see that partnership being long term?
I think it's to be determined. I think that's down the road. And I'll definitely let Mike answer, but for me, it's more about just kind of the immediate need to help these folks, and really just go from there, right, Mike?
Mm-hmm. Yeah, no, I don't have much different to say other than they're a great partner, very supportive, very flexible. Again, you kind of mentioned this, of folks start off with this one way of being, and then somebody somewhere changes the culture for whatever reason. We don't have that issue at all with Premise. They're fantastic, great support, and also have wonderful leadership too. So I think that we're happy where we're at. I did want to mention one thing, because I wanted to make sure, Brandon, you highlighted this too, on just quick. I'm sorry, this is not exactly what you asked, but being able to compare and contrast a little bit on just when a doctor finds out their answer of when they are submitting a request for a loan, getting approved. How does that compare, what we've built at Panacea compared to what you've seen in the market generally, Brandon?
Yeah, I mean, speed to market is extremely important. Probably one of the top priorities I had when coming over here. Our ability to get an approval quickly is not tough. We can turn around a deal very, very fast, under a week if need be. So, having that ability to help, again, the ability to help people when they need it. So if somebody comes to us and says, hey, I need to buy this real estate and fund in 30 days. That's like extremely difficult just from the appraisal standpoint. But if we can take it to our credit manager or head of credit or whomever quickly and get an approval, then that's what we're going to do. And so just being able to turn it around in a week, maybe two, is extremely important. And that's definitely at the forefront of our mind when we're helping people. So we're always asking on the front end, when do you need to close? When do you need your funds? And then putting that in the write-up immediately, and making sure we're hitting those guidelines for them, or those goals for them, excuse me.
Yeah. So, and I think, sorry, just the for doctors, by doctors thing. I mean, that hopefully bleeds through with everything we do, including that, like not wasting the doctor's time, giving them the ability to get that information quickly so they can move on to the next thing or find their other option or move forward with the financing, whether that's in the commercial side or the consumer side as well. I mean, like we had I think a couple weeks ago, a dentist that we helped with an acquisition got that done quickly. Also refied their student loans in, I think, 5 business days, all in that singular relationship. So I think it's pretty unique.
Yeah. So it sounds like it's not the typical mortgage application at the local credit bureau in town, right?
That's correct.
That's right.
90 days to buy a house,
Yeah, no, not at all.
Very good. Well, I'm curious because a lot of times you'll see newer players in the market are a little bit more aggressive because they're trying to get their name out there and they're trying to get deals under their belt and all that kind of stuff. And to do that, to be more aggressive, obviously you're assuming more risk. I think you mentioned earlier that you don't liquidate accounts. So like, for example, how do you balance your portfolio? If you're a little bit more aggressive on rate and terms and what your credit requirements and debt to income requirements are, asset to liability ratios, and you're a little bit more lenient there and will finance people that maybe a bigger bank that's in a box won't necessarily touch, you would be taking on a little more risk there, correct?
Well, there was quite a few scenarios you threw in there. I guess what I'll say is we want to be aggressive in the sense that in a common sense manner. So, for example, we're not going to have a strict guideline. That doesn't mean we're going to, fund a loan for, I don't want to call it a bad credit, but a credit that doesn't make sense, right? It doesn't cash flow, or they have a history of late payments, or all kinds of issues, that could be potential problems. So we're aggressive in different areas, but it doesn't jeopardize the strength of the portfolio, if that makes sense.
Okay.
So, if I don't know if you noticed, but we brought on quite a few people recently, one being a gentleman by the name of Rich Fortino, who has quite the history of running credit shops, most recently at TD's Healthcare Bank. And he's an extremely intelligent individual who's been in credit for a long time, managing risk a long time. And we, brought him on specifically to make sure that while we're being aggressive in how we fund and the terms and the amount, it's again, not jeopardizing the strength of the portfolio or the strength of those credits. Right. So I think an easy scenario would be if somebody who is an absolute stellar, credit with a ton of liquidity and their business cash flows like crazy, and they come to us and ask for a lot of money to do whatever they're going to do to build a new practice, and other banks have turned them down because the amount's too much just from some guideline, but the cash flow's there and everything else is there. That's somebody we're going to want to lend to. And that's what I mean by being more aggressive. It's not necessarily saying we're going to finance somebody who has a 450 FICO score, right? Or somebody who is just constantly making late payments, or somebody who has a ton of personal debt and absolutely no liquidity. Those are some, credit scenarios that could be tough to approve, and, historically may have shown that they have issues making payments on time. Yeah. I think it's hopefully that answers your question.
Oh yeah. I understand what you're saying. I guess my question was, and this is again, my ignorance and my interest in just understanding how the banking business works.
Sure.
But I would imagine that your unsecured personal loan of $75,000, that's probably one of that particular product probably carries a little bit more risk for the bank than, say, a practice acquisition loan where you financed 80% of the previous 12 months and the owner or the buyer put in $200,000, right? Might be the same person, could be the exact same person, right? Just two different loans. But the product itself would carry a little bit more risk than the other one. And so I would think from the bank's perspective, there would be a desire to not have 1,000 loans on this side and 2 loans on this side.
Right.
You know what I'm saying? Like it's got to kind of balance. And so one of the things that I've had experience with in the past that I really didn't care too much for was my first house. I bet my mortgage got sold 15 times in the 5 years I lived there. And I was like, would somebody please just accept me? I make my mortgage payment. I pay extra every month. I don't understand why nobody wants me.
That was probably the issue. Most definitely.
I was like, I felt
going to pay it off too soon. We don't want it.
I felt rejected every time it got sold. And so I would imagine banks kind of assess their portfolio periodically and then say, okay, we got a little bit too much here, not enough here. Let's set some goals here and let's get rid of some of these. Mm-hmm. Right. Do you guys, when you establish a loan, does that loan stay with you for the life of the loan, or are there times when you might, stays with you for the life of the loan?
Yes.
Very good. Very good. I don't even know if that is important to people or not. It's just
very important.
For me, loyalty is really big. And
listen, so I just closed a refinance of a healthcare facility in Florida, and we're paying off. We're doing a refinance, and we're paying off some of the loans that they had, and they went to get payoffs, and their loan had been transferred to a different institution, and they didn't even know that. And so we're trying to figure out. We run a lien search. We look at the liens. We see who those are, and she's like, I don't know who this lien is. And so they had to do a lot of digging. So most people don't like that, especially if they're not notified, right? Because they're making payments, and in this case, they needed to refinance that, and it became a hassle.
Yeah, so. And I can understand too that it may not necessarily be the financing bank's desire to unload it so much as it is an investor's desire to acquire it because it's secure. I know a bunch of people that there's I don't know where they do it, but I know a bunch of people that have like this website they go to. I've looked into doing it, but personally, I would rather own the piece of real estate than own the mortgage. And so you can go to this website and find mortgages, and, those mortgages are on time. People are paying it every month. And then you can find mortgages that they're not paying every month, or they're behind, and you can see what the interest rates are. And I mean, you can drop $65,000 and buy that mortgage, and you're making 7.5% or whatever the interest rate was on the mortgage when they financed the home, so there's just in terms of how to diversify. Mm-hmm. Because a lot of our clients, a lot of your clients, a lot of them are cash rich, man. I mean, they're high income earners, and there's a lot of cash. And I mean, wealth tip number one is make as much money as you can and keep as much of it out of the hands of the federal government as you can. So if I can get it, if I can put it in places that's making me more money, then I'm eliminating or minimizing my tax liability, and I'm getting, the return. Mm-hmm. So, I mean, it would almost even make sense. I don't know. I'm not a financial advisor, but you had mentioned earlier, Mike, that the best debt is no debt. And I totally agree with that statement. And if I've got a mortgage, or if I've got a loan, if I go to the bank and get a loan at 3% interest, 5% interest, let's say on a piece of equipment, piece of technology, or maybe even rehabilitating my facility and adding 3 or 4 operatories, right? If I go take out $150,000, $200,000 loan at 5% interest, but that $250,000 investment in my business is going to allow me to grow 35% over the next 12 months. That's really good debt, because my net on that is, 30%.
Absolutely.
So I would say, I'll take that. So I imagine there are people with, good credit that could come to you, get a personal loan, go buy one of those mortgages for $65,000, $75,000. It's paying 8.5% interest.
Yeah.
And make a couple of points.
Yeah. No, I mean, I think there's, I think that not a lot of universal truth statements in this world. That's probably not one of them either. Looks like you said, there's lots of nuance there in those situations where you can definitely play the kind of margin game and figure out where to put your money. But as working with the doctor population, there may or may not be some of us that have that ability to have that nuanced understanding financially, being that savvy with debt and how to utilize it to their advantage. So yeah, that makes total sense. But to address your question, and I don't know if we can really truly answer it, but our company, we're relationship based, right? I mean, we desire to have a good relationship with our customer, be able to offer the full suite of financial services, and that inherently does diversify. The other thing here is the deposit relationship makes a huge difference, right? I mean, that helps us with our funding costs if we're able to get that deposit relationship as well. So inherently helps us from a risk perspective on financing the loans. So we're able to take the deposits, we're able to take the commercial, we're able to take the consumer loans. I do think in the future we will be able to do residential mortgage. We do not have that ability at the moment, but that would even help us in a even better ability to diversify too. So, just with the nature of our customers, we want to keep those in our relationship bank. We want to keep those relationships in-house, get all the touch points, like you mentioned at the very beginning, with the customer we can throughout the year and throughout their life cycle, so that we can continue to offer them solutions that they might need.
Okay. Equipment loans. You guys handle that?
Yep.
Okay. Equipment loans and construction loans, if they're building out, 3 or 4 additional opportunities to equip those.
Absolutely. Yeah.
Obviously, practice acquisitions, startup loans. Don't necessarily have an SBA product in-house, but Premise does. So that would be something that you could hand me off to.
I always go back and say, well, what are the funds for? Right. And then figure that out. And we have a product that can handle whatever that answer is. The guidelines are just a little bit different than the SBA, and those, the options are much more favorable, except for the down payment's a little bit different. 10.
Now, are the equipment loans and like construction loans? What else did I mention? Even a debt restructure loan, is that the PRN product that would do that? Are there caps on that? Am I limited to 75,000, or is that something different?
Yeah, no, the PRN is really designed for the consumer need. Some people can use that if they wanted to, in theory, for equipment, but we have an actual commercial equipment product specifically for that. So you could go above 75,000.
Yeah,
okay.
There's caps on the PRN. Mm-hmm. But then, we have all the commercial stuff to take care of the business, from starting your first office or buying your first office to starting your 5th or buying your 5th office, and everything involved in that.
Very good. So you've done, first one was in November of 2020. We're 12 months in at this point. Are you guys ahead of schedule, behind schedule? Have you done as many loans as you hope to do in your first 12 months?
I would say yes. And I like to think about it this way. I mean, in about a year's worth of time, we have, close to 1,000 doctor customers across the country, 48 states, which is ahead of where we thought we'd be. Yeah. Now, certainly, I don't think we're going to have our name on the side of an NFL stadium anytime soon. But if you look at, maybe, who knows? If you look at SoFi in their first 2 years, they had about 2,500 customers at the end of their first 2 years. I don't think it's unreasonable to think that we'll be pretty dang close to that. And it's not just all comers; those are doctors that are our customers. Yeah.
And I didn't have a great experience with SoFi. I hate to say that. I don't want to burn any bridges, but I think I was trying to consolidate my student loan, which is minimal at this point. I should just pay it off. It's like, I think I owe like $9,500. But I should just pay it off. But my financial advisor was like, "Oh no, man! Well, it's 7.5% interest. We'll stretch that thing back out." And I'm like, "I don't want to stretch it back out.
No.
Yeah, I would rather just pay it off and be done with it than, And I think I'd gone through SoFi like 2 years ago, and they wouldn't refinance it. And I was like,
"That's what I mean."
I was like, I know my financial position. I know I'm not a risk for you. I couldn't understand why they didn't want to do it. Maybe it was just too small. Just wasn't a big enough.
Maybe. But imagine you got 295,000 and you're a dentist who hasn't made $1 yet. And I mean, that's even harder to get a good shot at refining with a lot of these companies. Cause like I said, they have a website and they have people with white coats on it, but like actually effectively having a different product that caters to them. I don't really see that in the market right now.
I would also say, I don't know how SoFi got up and running, but I do remember they hit the market and kind of blew up pretty quick. And I don't know that I would have met you guys if I hadn't have met Brandon through Jonathan. But when you see a company go from inception to like mainstream that quickly, there's private equity pushing that thing, man. There's no way to get there. There's no other way to get there that fast.
Absolutely.
And so I'm shocked to see you in 48 states because we own my partners and I own all the franchises here in the Southeast for the most part, Tennessee and just about every state that touches it. I know how hard it is to build brand recognition in a market, and to go from 0 to 1,000 customers inside of 12 months and 48 states, man. That is an impressive rate of penetration. I mean, impressive.
Yeah. Well, I mean, we've Brandon works his tail off. We all work our tail off here. We got a great team. Premise is a great team. I'm not trying to just say a bunch of BS like a basketball coach after a game and just a bunch of hot air with no meaning behind it. But truly, we really have a team that works their tail off. And also, I do think, look, doctors love word of mouth referrals. I mean, they see other doctors more than they see their own family. So if you get those good experiences, it spreads pretty dang quick. Yeah. And for us, that's been a huge source of our business too.
Yeah, I wouldn't ever I understand what you're saying. And the way I'll tell you from another person's perspective, the way it came across was not braggadocious by any stretch of the imagination. If you're good at what you do, you're good at what you do. Right? There's a big difference between confidence and arrogance, and I think confidence is a very admirable quality. If you're not confident what you're doing, you need to go back to the drawing board and figure out what needs to change so you can be.
That's right.
But there's a great American philosopher that says it's not bragging if you can back it up. His name is Kid Rock. So yeah, man, I think you guys are definitely onto something. And it sounds as though, the results are speaking for themselves, I think. Moving very quickly in 48 states, 1,000 clients across the country. Yeah, man. I think your heart's in the right place. I think your intentions, I think you're very intentional about what you're doing. You've identified an opportunity in the market that's very solutions oriented. And so, yeah, I think I'd like to see how things pan out for you over the next 12 to 24 months. We'll take SoFi down, and then I'll bring my $9,000 student loan over to you guys.
That sounds good.
I'll make you pay it off.
Oh, man. No, it's been fun. Thank you so much.
Appreciate those comments very much.
Oh, you're very welcome, man. It's true. Like I said, I like probably what I like about doing this is one of the reasons I actually started doing these podcasts was I would find myself in conversations with people, and in the process of that conversation, I'm like, man, there was some really good stuff that came up in there. I wish that was recorded so that people could listen to it, because 9 times out of 10, the most valuable stuff that I come across isn't in a book, and it's not in a continuing education event. It's in a casual conversation with someone else in the industry. And I'm like, man, I wish I had that captured, So I was like, well, why don't I just start recording it then? Because it's generally when you're not trying to, what's the word I'm looking for? When you're not trying to convey a specific message, it's kind of like, just wherever you feel the value is, that's what comes out. And that's, I think, what people want the most of.
Mm-hmm. Yep.
So yeah, I'm grateful for the time that you guys have invested with me this evening. I hope we have the opportunity to do it again sometime in the near future.
Absolutely.
And
bring that on.
Yeah, maybe we'll be at the $2,500 mark or 2,500 client mark, before the 2 years is up.
We'll see. TBD. I feel good about it. But yeah, this has been real fun for us. And I appreciate the venue to be able to talk and hopefully convey some good info.
Yeah. Thanks a lot, Jon. Really
Very
appreciate
welcome. It's been my pleasure. Hope you guys have a wonderful Thanksgiving with your families.
You too.
And you're not working on Thanksgiving, are you?
No, not unless the doctors are calling me and they have questions. Then
Okay.
that depends.
Mike, you're not working.
I'll see. We'll see. I will do my best to try to stay have my head at where my feet is at. But that is a struggle for me sometimes. So
I totally get it.
We'll see.
Yeah. We need to make sure your son knows where you live.
I know we do. My wife will take my phone away midday. So after that, I'll be fine.
Very good. All right, guys. Well, thank you so much. I've enjoyed it. I appreciate all your input and for your time this evening. I hope you have a great Thanksgiving, and I'll look forward to talking to you both again soon.
Sounds lovely. Thank you.
We'll talk to you soon.
Right. See ya.